Hello again and welcome to the second chapter of the course where we're going to have a look at the market structure basics. So I'm going to explain to you why is market structure so important. We're going to identify the three types of markets and I'm going to introduce a little rule that is really going to help you every single day when you start your trading day. Then we're going to identify the market structure in trending markets. We're going to identify the structure in ranging markets. And I'm going to give you tips and tricks on how to approach it, right? So when you see a trending market, what do you do? And when you see a ranging market, what do you do as well? And then we're going to have a little bit of an exercise. I'm going to really teach you how to flow with the markets, how to follow it, and how to analyze it like a pro, all right? I'm sure you're excited, so let's just give it a start. First of all, I would like to start by explaining why is market structure so important. Well, it is the breathing pattern of the market. It is how the market moves. It is what you're going to see every single day that you just open your charts, all right? So a question might pop into your head right now. What is the difference between price action and market structure? Well, what is price action first, all right? So this is the words speak for themselves. It's the action of the price. It is how the market moves. It is the candles that are printing on your screen that creates the actual market structure, all right? So actually price action creates the market structure. Because market structure is, again, we're going to see exactly what it is. So right now, let me give you, again, in order to illustrate this even much better, I want to give you a little example. So I want you to imagine a painter and his blank canvas. All right, so he's about to paint a picture or whatever he does. He uses his brushes and colors to fill that empty canvas and come up with his masterpiece. All right, so he has an idea in his mind. He has an intention. And then what he uses is his brushes and colors to kind of translate that intention onto his canvas. All right. So now I want you to imagine a blank chart. You open TradingView and everything is blank. All right. And once you start seeing the candles starting to print, this is price action. So you're going to see price action that is printing on your chart. You're going to see the candles. And this price action is created by all of us. All right, so we are the painter. Well, we, the institutions, the banks, the hedge funds, the central banks, and the big guys. All right, we paint the market. We are the painters. All right, but as I have said, but mainly the big institutions, they are the ones that control the money and the market direction. And they control like the price from one pricing to another, and then they're gonna rebalance it. So basically they are moving the market and they are printing the price, right? Because they have all the money and they have all the brushes and all the colors in order to really influence our canvas, our chart, right? So I really hope that little example is clear so that you know how actually price action is printed, and you can always refer to that painter with his blank canvas. All right, therefore what we have to do is we have to be able to anticipate and know what the next brush stroke of the institution is gonna be. All right, and this is what actually at the end is gonna make you money. Because if you know where the institutions are gonna go from a certain level, if you know where the market is gonna move, if you know the next move, the next brush stroke, then you are potentially gonna get into that trade, and this is how you're gonna make money. So you need forecasting skills. All right, but market structure makes it super easy for us to do that. All right. So next super important thing, being able to read raw price and not rely on indicators is the best skill you can learn. I can totally vouch for that because I started with indicators. I started with all kind of fancy stuff, and I'm sure most of you may have gone through it or are currently going through it. And I'm going to tell you, dump all of your indicators. Like, yeah, if you really use it, that's fine, but you really don't need them. Why you don't need them? Because actually the price action, the market structure is building up the indicator. So you know the price action stays on top, then we have market structure, and then we have the indicators. And the indicators are like lagging. They are developing after the market structure and after the price action has developed. All right? So this is something that I want you to know as well. And of course the market builds a story, and the big institutions are always going to leave footprints. Right, they're always going to be leaving footprints of where they are potentially going and where they are potentially targeting for the price. And if you can read between those lines and understand what structure is doing, you will be unstoppable. Right? And again, market structure lays the foundation of every strategy. If you don't understand market structure, you will have a really difficult time. Because if you just base your trades on indicators, cool, it might work out. But do you really understand what is happening? Because indicators are built from the price, from the market structure, from the price action, right? They take the data from the chart and then they make it into an indicator. And this is why I don't like about indicators, because if I can read raw price, then I don't need that indicator, because I know if a market is oversold or overbought just by looking at the chart. All right. So the aim of this mini course is to lay a strong foundation of your market structure knowledge so that you're ready for more advanced strategies. All right. So right now we are going to lay out the foundation. All right. So are you excited? I'm sure you are. Let's see what we have. All right. So little question for you. Do you think that there is a market that moves in a straight line like this? Probably not. Maybe Bitcoin, who knows? But even Bitcoin, if I jump on a chart, even when it's strongly pushing to the upside on the weekly time frame, like this big exponential move, if you jump on the hourly time frame or the hourly, it's gonna be creating this sort of structure. All right. Does price move in a sequence of higher lows? Yes, it does. And I'm sure most of you know that the market cannot just go from one point to another without stopping to take a little break and to pull back, because this is the breathing pattern, right? You exhale, then you inhale in order to exhale again. Right? So this is something that I want you to know. There is not a market that's just going to move from point A to point B in a straight line. Right? And then I want to answer some questions as well. And right now we're going to answer some pretty basic questions. And I'm again going to prove to you why is market structure much better than, for example, support and resistance and all of those things. Right? So first question. Why is market structure better than classical support and resistance? And I'm just going to show you on my chart. I'm just going to put the chart right there, and let's do something right now. All right, let's be on the 4 hourly time frame. So I will just plot some random horizontal lines across the chart. I'm just gonna zoom out like this, and I'm gonna plot horizontal lines like this. 1, 2, 3, 4, 5, 6. All right, it was super random. If I zoom in, what I'm gonna see? Oh, look at that resistance. It reacted. If I go on the right, oh, look at that, support. It faked out a little bit, but it's fine. If we take the next line, okay, it doesn't react from here, but if I go on the left, at some period of time, it will react. But if I go again right there, let's have a look. It tapped and it reacted. This is the support? Yes, it is. Going to the upline, have a look right there. Little resistance, break, retest, fake out below. Again, you see how it's consolidating. Then we broke. We retested this resistance to perfection, and then we created an uptrend. Wow, really nice. Then going on to the right, have a look at that, how precise it is. We tapped into it, we reacted, then we broke, kind of again going around it, then we tap again, nice long opportunity break, retest, we have a short. All right. If I take this one, have a look at this, really nice tap, nice resistance. Then again, we break, retest it, and you can see if I go on the next chart, and if I just do again, boom, 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 or something like that, again, you're gonna see, have a look at that, support, support, support. Have a look at that, support right there. Have a look at this line, support, broke, and retested and turned resistance. Have a look at this, resistance, resistance right there. And if I just go on the left, without looking at the price, you're always gonna see the market react somewhere to those lines. And this is why I don't like support and resistance, all right? It's too vague. You can draw it everywhere on your chart, and wherever you draw it, you can make it look good for your eyes. So you're gonna be like, okay, look at that. So let me do this, for example, right now, because yeah, it broke, retested, pulled back resistance, and now I'm gonna be looking for shorts, but you get stopped out and you don't know why, right? So this is the problem with support and resistance, and this is why we're always gonna focus on market structure from now on. So back to the presentation right now. Next question, why is the market creating a sequence of pushes and pullbacks? All right, so have you ever thought, why do we have those higher lows and lower highs? All right, so I want you to give you an example of, for example, going on a trip, on a sea trip, or maybe going for a marathon, to run a marathon, all right? So here you have point A, this is where you start, this is your home, and this is the final destination, your C, or this is where you start running and this is where you finish your 100 kilometers run. All right. Do you think just by getting into your car, you're just gonna go in one drive and drive like 300 kilometers or run 100 kilometers without taking a break in between this kind of distance? All right. No, you're not. Right. You're gonna stop. Then you would like to, let's say, have to eat something. You're gonna stop at the gas station. You're gonna go to the toilet maybe, all right? Funny examples right there. Then you're gonna start again. Oh, the car ran out of gas. We have to stop. We have to rest. You recharge again, all right? You recharge. Then we go again, all right? Oh, something else happened. Maybe the trip is so long that we have to take a break. We have to sleep. Okay, we take a sleep again. Next day, we start and maybe take one more break until we reach our destination, all right? So I hope this is a clear example. Again, it's a little bit funny, but it's the same story for a marathon runner. He's not just gonna start from the beginning and run 100 kilometers in one run. All right, he's gonna run for 20 kilometers. He's gonna take a little rest. He's gonna run another 10. He's gonna take a little rest. He's gonna run another one. He's gonna take a recharge again until he reaches this. So this is why, guys. This is why, because once the market moves to the upside, it just cannot continue. It has to take a break, because at every level there will be sellers coming from the left, for example, or it just has to pull back. All right, this is how the market moves. You have a push and then you have a pullback. Why does this pullback occur? Because the banks want to redistribute price. They want to rebalance price, because if you have a push, they are taking profits right there, right? They're taking money out of the table, and this actually results in a better pricing to the downside. So they're gonna buy again from here. Once they have a high, the market gets a little bit too high, so it has to come lower again. They're gonna take profits in order to get a cheaper price in order to buy it again. All right, so this is the psychology. This is why the market moves like this. It always has to pull back, and it will always create that pullback before a continuation to the upsides. All right, and if we just go onto your chart, you don't see a line to the downside. You see a push, little pullback, push, pullback, push, pullback, push, pullback. All right, it's everywhere. You have this strong push to the downside, but the market is gonna pull back at some point in time. All right, why? Because the banks just need their orders. Let's say they went long from there, they're gonna take their profits here, which is gonna react to the downside. Then they're gonna take another long, and the market is gonna move up until eventually the market is running out of steam. It fails to make a high, and then potentially we start reversing to the downside. But this is something that we're gonna touch on a little bit later. All right, so I hope those very simple examples are good so far, and you're understanding with those a little bit stupid examples from my side, but I hope it's clear. All right, so next question: when do we confirm a higher high or a lower low? All right, so again, jumping back to the charts, we are gonna be using wicks and bodies. All right, so in order for a higher high to be confirmed, let's take this because this is a clear example. You want to see a body close above the high of this wick. So if this candle closed above the high of this wick, this would have been a higher high, but you can see it's not, and this will really help you guys to really distinguish between when do we have a higher high and when do we do not, and the same for lower lows. And as you can see later, the market reversed. If we have another example right there, do we have a higher high right here? So let's say this is your high. Does the market break and close above with a body close above the highest wick? Yes, it does. Therefore, we are looking for longs. The market then pulls back, creates a higher low, and then we push into the highs. Do we have a higher high? Yes, we do, because we close with a body close above this high. And this is how you can easily as well identify when the market is reversing, right? But this is how we are gonna identify structure, right? In order to break a low, the market has to break the lowest point of this low and close below it. Here is your close, then we wait for a lower high, here it is. And the market should not close with a body close above the previous lower high as well. And we do this until, so let's say right there after this push to the downside, this right there will be our lower high. Does the market close right there? No, it doesn't. So still right there, we could have taken a short, this move to the downside, but then later we actually close above. And this confirms the first higher high. And what you can see later, the market gives a little bit of a bigger pullback, but at the bottom, do we close with a body close below the lowest point of this wick? No, we don't. And we create a double bottom, and then we create a reversal. All right. So again, what we're going to be using is wicks, the wicks of the structure, and we will gonna be needing a body close above. I really hope that's clear. If it's not, always make sure to throw questions at me. I'm gonna be there to answer. All right. And I'm gonna be giving you more and more examples of that. And first of all, how do we know when a lower high or a higher low is created? So we can take a trade. And this is probably the most expected question, and we are gonna get into that soon. So make sure that you are watching the course till the end. All right. And finally, let's have a look at some details. Again, the market will always create impulses, and another name is pushes that are followed by a correction, pullback, right? Usually the impulses should be strong, long-bodied candles, while the correction should be slow, small-bodied, and corrective candles, all right? Because during the impulse, the market is really impulsing strongly, the banks are buying, and there is strong imbalance of price. And during the correction, they're usually like this, because again, the banks are stopping just for a break, and then to potentially launch more positions. They are accumulating and distributing their orders, they're taking profits around those areas. And then usually you're gonna have another strong impulse to the upside, followed by a nice and corrective price action. So again, guys, we have to learn how to distinguish between impulsive and corrective price action. Impulsive is strong, pushes to the upside, and corrective is nice, corrective, small bodied candles. All right. And a little tip again, the number of candles creating the impulse will usually be lower than the amount of candles creating the pullback. All right. So taking all those three things right there, can we spot them all the details on this little uptrend right there? The market will always create pushes and corrections. Push, correction, push, correction, push, correction, push, pullback, push. Good. Tick one. Usually the impulses should be strong, long body candles, while the corrections are small bodied candles. Nice impulse to the upside, little candles for correction. Beautiful impulse to the upside, really small candles for the correction. Again, 3 candles of impulse, twice more for a pullback. 2 candles for an impulse, much more for a pullback. And again, you can see how clear the blue candles are, the impulse, and then how like small the black candles are. Second tick. The number of candles creating an impulse will usually be lower, and we already had a look at that. 2 candles of push, pullback. 3 candles of push, 6 candles of pullback, 2 candles of push. Again, the same, much more bigger amount for a pullback. All right. So this is how we're going to wrap up this first lesson. I really hope you got something from it. This is just an introduction, and I laid out some pretty important concepts. Again, make sure that you know when a higher low or a lower low is confirmed. Remember, a body close below the highest or lowest wick. And again, make sure that you know the market is always going to be moving like this. So you never can expect the market from this area to reach the high without stopping for a little break. This, again, kind of reacts to your psychology, because when you take a trade, you're like, okay, I'm going to take my take profit right there, and I'm just going to expect for it to hit. But sometimes it can take a long time, a long journey until that take profit. All right. So we're wrapping it up right now, and let's have a look at the next lesson.